Welcome back to Squawk Box. Rick Santelli here with live breaking news. Our November read on trade balance, which will be a deficit, comes in at minus $43.1 billion. That's a tad smaller than expectations. Sequentially, the 47.2 in the rearview mirror drops below $47 billion to minus 46.9. Now, 43.1 is the smallest trade deficit since October of 2016. So making some progress there. Of course, we have factory orders and durable goods yet to come. We have popped over 180. Remember, we're right around the 185 to 187 level on Thursday before the Iranian news. And earlier that morning, well before the Iranian news, we were in the 190s. So we are coming back a bit. Dollar index is up, although it is hovering at some of the lowest levels since July. And the Chinese currency, the yuan, is at the best level since August of this year. Becky, back to you.
Rick, thank you very much. Steve Liesman is here. He's been looking over these numbers, too. He's got some insight to it. What do you think?
There's so much going on with this data here. And normally we don't spend a lot of time.
Because of the Boeing situation, because of what else?
Brilliant, Becky, quick. I mean, it's Boeing. So I have here exactly that number I was just looking at. A decline in aircraft exports, a decline in, actually an increase in November for agricultural exports, but overall we're running below year to date by about, it looks like about $4 billion.
That's interesting, though. The increase in November in agricultural, is that because the Chinese had started picking up and buying, or was that before they agreed to some of those purchases?
I think it might be too early. It could be a situation where U.S. exporters are finding alternative markets for some of their goods.
Oh, which would be even better news.
It's a commodity, right? Yeah. So the other thing that's happening is you have this decline in imports, but you have exports also declining, but not as much. And then to tie everything I've done this morning together into one knot here, the reason why U.S. exports have held up reasonably well, given what you talked about earlier, which is Boeing, is because of oil exports. That has helped the U.S.
because
trade
we are
position
exporting
in part.
Oil.
Right. Now,
as we continue.
Right. Now, you could get happy if you wanted to about the improving U.S. trade position, to which I would suggest go ahead and get happy, but it's a little early. We have a lot of gyrations in the data from the trade, right? We got rid of the possibility of the additional tariffs in December, but the tariffs from September remain. So I would say we're going to need a couple quarters to really understand, A, how the tariffs are going to affect trade over time. And then second of all, to let it all even out and get a feel for where the real true trade balance is and the effect. Because remember, we bring it in, and if we bring in less of it, that helps GDP, but inventories don't go up as much.
So you're talking about a few months of data that we still need to get before. So we're not necessarily going to have a very clear outlook on some of these things that are happening with the Chinese and the trade negotiations and their potential purchases of agriculture for several months to come.
And ergo, not growth, okay? Because what we are is somewhere in this 1.5% to 2.5% GDP range.
Big range, though.
We came into the fourth quarter looking at 1.5%. Now we're closer to 2%. And what I have seen is because of the trade situation, economists have boosted the fourth quarter, but they're taking it away from the first quarter because of the inventory and the right. So what we're looking for here is we've had a growth slowdown, that's for sure. The more important question for the market that it's been trying to game out is where's the bottom of the slowdown here? It had thought to be the fourth quarter. Now it seems to be pushed ahead to the first quarter with the proviso that we have easing trade tensions. And that helps business confidence come back, which helps business capex come back, which means we'd have a rise towards a 2.5% growth rate by the end of this year.